What's going on, everybody? Welcome back to the Commercial Real Estate Investor Podcast. I'm your host, Tyler Cobble, and today, Andy and I are going to be kicking off a new series for y'all on the YouTube channel where we're going to be live underwriting an investment that we find, whether we think it's a good deal or a bad deal. We're going to show you how we go about the process, how we find these deals, and actually how to go through the underwriting process to determine whether or not it is worth investing in. So, Andy, what's going on, man? Good morning.
Good morning, Tyler. Nice to see you. Yeah, excited for this show. Hopefully, you guys can follow along with us at home and see exactly how we look at deals, how we value them, and what are the criteria that we're looking at when we're trying to evaluate, is this a good investment or not? I think that's really the most important decision that comes to investing is this going to actually make you money? And this is the kind of the basic fundamentals that you really need to get down in order to value those investments correctly.
That's exactly right. So we'll be doing this live underwriting each Wednesday at 5:30 p.m. Central Standard. So feel free to join in and watch us live. We're actually sending this out to our investment list as part of our the weekly daily, or what is it? But I'm forgetting the name of the newsletter, the Deal of the Week newsletter that we send out, where we underwrite these deals and send them to our investors. We actually sell a number of investments this way. So figured we might as well show you guys kind of how we underwrite them as well. So Andy, what are we underwriting today?
Tyler, today we're going to be underwriting a little oil change place called Take 5. It's one of those, if you've ever heard of Valvoline Instant Oil Change or any stuff like that. I actually got my car serviced here one of them, and instead of dropping off at a Firestone where you drop your car off for whatever 2 or 3 hours and you have to go get someone to pick you up or take an Uber, go somewhere else, go get a lunch, you just drive up and then they change your oil, they do other little maintenance and other little repairs on you on site, then you drive away, you're done in like 5, 10, 15 minutes. So that's what we're underwriting today, and hopefully you guys can see this is an example of a triple net investment. It's something that we've been trying to highlight here on this channel for the last couple of weeks now. And it's one of the easier investments that you can learn to start underwriting with. So we figured this would be a great place to start for you all to follow along at home.
Yep. Absolutely. So that's a pretty neat little concept. I mean, obviously it's COVID proof. I would imagine as far as tenants go, this is going to be a relatively stable one, but I know you've got a net lease cheat sheet for us. So let's dive into that first and talk a little bit about what, the different kinds of triple net tenants are that we can be covering.
Absolutely. So this is a net lease cheat sheet that I got from Matthews Investment Services. You can find a lot of these different types of cheat sheets online. If you just Google net lease, tenant list, net lease cheat sheets, you'll be able to find different lists like this that go over the different types of tenants in typical triple net lease properties. So this is an important thing to look at, right, when you're trying to go value a property, because you want to see, is it within the range of what other properties like this are selling? What is the credit risk of the tenant? How is the health of that company, right? And a lot of these things will be pretty obvious. We can go over actually a few of them here, just at a very high level, if you'd like, Tyler. But
Yeah.
at the end of the yeah, okay, let's do that.
Well,
But at
let's
the end
let's
of the
cover
day,
let's cover similar tenants to this one. So auto services. And one thing I do want to point out is that every deal that we will be underwriting is actively for sale. So if this is something that you're interested in buying, my contact is in the description in the YouTube video below. So go ahead and feel free to reach out to us. We can send you the underwriting, and we'd be happy to talk about helping you guys acquire this property. So auto services, Andy, what do they look like?
so if you see here, Take 5 oil change, right here, Take 5 oil change. Credit rating, it is not rated. So an interesting thing about net lease properties is that certain companies, like if you scroll over here and we look at Bank of America, Chase, Wells Fargo, they're going to have really great credit ratings, and they manage our money. So if they have terrible credit ratings, you probably don't want to have your money with those banks if their credit ratings themselves aren't even very good. So the point is being said is that something to consider when you're looking at these triple net properties is whether or not it's a corporate guarantee, right? And if it is a corporate guarantee, how good is their credit? Because the better a corporate, the better their credit, the more likely it is to be a safer, less risky investment, right? So for something like Take Five, it is not actually rated, so it's probably going to command higher cap rates than a Bank of America would. And I think you can see this here. Take Five average cap rate range is in the 5.5 to 6.5 range, and then you go over here to Bank of America, Chase, Wells Fargo, it's more in the 4.5 to 4.75 range. So that's always something to take into consideration. There is the tenant's credit rating. You can see here the average cap rates for the company's properties in 2017, 2018. Looks like from 2017 to 2018, it actually fell 0.1 percentage points here in the cap rate, and that's good. That is if you own the property already, right? You want cap rates to go down. That indicates that your value and price of the property will go up, and potentially that means that the cap rate will go up or continue to go down in the future. And you should not underwrite that way. I recommend against underwriting that way, and Tyler, we can go into more explaining why in the future, but having that history and context there is also pretty important to understand that potentially the cap rates could go down in the future, which would be great for your valuations. And you can see here, sometimes these leases will be corporate guarantee or franchise guarantee. And that can be both a blessing and a curse. Sometimes a corporate guarantee is not as good as a franchise guarantee if the corporation is not having as good of a credit rating. And this you see a lot more with fast food restaurants where, someone like a Taco Bell, a Pizza Hut, or Wendy's, any of the Yum brands, there's going to be corporately owned stores and there's going to be franchise owned stores. And sometimes franchisees actually run their stores better than corporate, right? And if you've ever been to a lot of different fast food restaurants, these different tenants, often in different locations, have way, way different levels of service, et cetera, et cetera. So these are just all big factors to take into consideration when you're investing in any specific property. So typical lease term is 10 years, which is what the lease is on this property, and is a triple net lease. So I believe, or it might have been a ground lease.
I think this one's actually a ground lease, which means that it's even less responsibilities on the landlord, which is pretty exciting.
Yes, I do believe actually this one was a ground lease. So yeah, and we can talk about how that affects our underwriting here in just a second. But that's the important thing here. And here we say, do they report store sales? They do not, but their tenant future outlook rating, at least according to Matthew Services Group, is safe. And Tyler kind of touched on that before. I mean, at least within the next 10, 15, 20 years, you're still going to have people changing oil in their cars. The EV revolution is coming, but it's not here yet.
That's right. Yeah, and one thing that we found too is that even if in 15 years there's no more oil changes, right, or 10 years from now this group decides not to renew their lease, these are smaller buildings typically in very high traffic areas, and so they're very well suited for an adaptive reuse. Which is pretty exciting. I mean, we've seen these, auto garages turned into cafes, turned into retail boutiques because they've already got tall ceilings, they've got nice rectangular footprints, they've got large glass garage doors. It just makes a lot of sense for those kinds of uses. So as far as your downside risk goes, 10 years from now, your tenant not renewing, this is actually a pretty decent one. It's not like you're having to deal with some 20,000 square foot floor plate that was specifically built out for a TJ Maxx or something.
Exactly. Yeah, the smaller buildings on high traffic areas, it's at the very least, if you are buying in a good location, land value itself might be appreciating over time, right? If you're buying in a growing city, that's always something to consider as well. And why we see those cap rate often declines as well. So, just looking briefly at some comparisons between something like Advanced Auto Parts, AutoZone, O'Reilly over here. They have a much wider cap rate range because some of their stores are going to be much, much older versus much, much younger. You're going to see the newer store is going to be at the lower end of that cap rate range, and the older store is going to be at the higher end, because you can see You might have to do more of the actual property maintenance and upkeep because a lot of their leases are only double net leases. There's all these things to consider when you're looking at these different properties. And then also here, Caliber Collision, Firestone, and Goodyear, they're also kind of a much wider range. And obviously, their properties are older as well. And uh, the thing is, between these companies and something like this Take Five and or maybe Valvoline, is that is that these are obviously much smaller properties. They're lower priced, and as Tyler said, because they're smaller and lower prices, like something like this is going to be easier to retrofit than a big Firestone with 6, 7, 8 garages and hydraulic pumps and lifts and all that kind of stuff. It's really only going to be used for a car shop, and something like this would change.
Yeah, I mean, look at that typical price range. You're looking at between 700,000 and 1.5 million. As far as triple net investments go, that's a pretty low range, which we find to be pretty exciting because we have a number of investors that want to go into these solo with a 1031 exchange out of residential properties, or maybe a 1031 exchange out of an office building that they're not going to have 3 to 5 to $7 million to use in a 1031 exchange. But this is a good opportunity there.
Absolutely. So, with that being said, we can now pull up here in just a second. I'm going to stop sharing my screen, Tyler, to the actual underwriting. Let's go over this underwriting for you all and show you the spreadsheet that we often use to actually look at these deals. So, here it is pulled up. Property name, we're going to call this a Take Five. Let's see if I can actually type. A Take Five oil change. It's in the Nashville general area. And this is, you see these blue boxes here. And if you guys haven't seen Tyler's full underwriting video where he breaks down how to use this spreadsheet, it is on the YouTube channel. But just on a very general high level, these blue boxes here are boxes that you're going to want to edit. The white boxes are pre-filled formulas, so you should not edit them. And otherwise, it's pretty self-explanatory, where you see square footage. I wonder what you put there. You put the square footage of the building, right? So the square footage of the building is 5063. The purchase price, at least the list price for sale, is almost 1.2 million, 1,190,000. And so capitalized rehab. So on a typical property, you would have to come out front, potentially with, repairs and repainting, fixing doors, fixing HVAC units. But again, as we talked about earlier, this is a ground lease. So your capitalized rehab is a big fat zero. You don't have to do anything because you're not responsible for the building. You're just responsible for collecting the check, which is a pretty good responsibility. I will take on that responsibility pretty gladly.
Yeah, it makes it pretty good. I mean, it's pure mailbox money, right? I mean, the great thing about this is it is a ground lease. There is zero responsibilities on the landlord's part. By the way, this model is available for sale if you want to start underwriting your own deals with it after you watch this video. That link is in the description below too.
We have here 3% closing costs, which is pretty typical in the range. Because you're going, and these are going to include your title, transfer tax, insurance, prepayment, escrow money, all that kind of stuff. Yeah, legal stuff. And for something like this, you might have less or more, just depending on the fact that a lender might not require a full property report on a building like this, since I believe this one was brand new, built in 2020, so that it makes, if it was built last year, you might be able to save yourself on having to do a brand new property condition report. And there are different factors that go in and out, but from a very high level, you want to start 3-4% is going to be good for your closing costs. And operating capital, I mean, you don't need any. And so that's not typical for a building, for going in to purchase an investment property. Usually you want 1 month of operating expenses, and you're going to want some reserves in case something breaks. If your HVAC unit breaks and your tenants have no HVAC and you're responsible for fixing that, you need to have that money. Otherwise, your tenants are going to be super angry, they're going to leave, it's going to be doomed. So you usually want some operating capital here. But again, as a ground lease, you're not responsible for literally anything. So that makes something like that, you don't even need any operating capital, which, as Tyler mentioned before, this is mailbox money. It makes the property easier to manage, easier to operate for you because you're not really operating anything, and also easier to underwrite, as you guys are seeing here today.
One thing that I will add to that as well, if you're paying cash, you likely really don't need any operating capital. If you are getting a loan, you may want to set aside 1 month of mortgage payments just in case the tenant pays late or for whatever reason. That way you have at least a little bit of a reserve built in there. But yeah, if you're paying cash, I mean, it's not like you have a payment that you're going to have to make if that tenant misses anything. So,
right. So we can underwrite this in two ways here, Tyler. We can actually show it what it would look like on a full cash deal, and then we'll underwrite it too for you guys on what a more financed deal would be. So let's actually do
it's
that.
perfect.
So here on the financing, you see a couple tabs here for an all cash deal. So this tab here requires you to input your down payment, right? And down payment is how much money you are putting up front. Let's just make that 100. So that means you're buying this full property here, 1.19 million in cash plus $35,000 of closing costs equals 1.225 million. So this is really essentially your property closing costs, right? How much money you're spending to acquire the property. That is your cost basis in the property. So with the down payment 100% here, the rent here is actually rent per square foot is kind of meaningless because at least on this, it's really just a lease that you're signing. So you're not really based off of a certain rent per square foot here. The starting rent here is $68,500. Okay, so it is $68,500, and you can see it actually is auto-populating here. And what you can do is you can put in, if I, for example, wanted to put in growth rates here, I could put it in as it is set this cell equal to the previous cell. Let's do that. If I wanted year 2 to be 3% higher, for example, than year 1, I can set this cell here to be that cell times 1.03, right? And then you can see here that number goes from 68,500 to 70,555. So
these are annual numbers, by the way. This is each year.
Yes, each year, a year's worth of rent. So that is something that I can do there if I wanted to. But on this specific lease, it is the same price for the first 5 years. And actually, in year 5, 2026, we're going to have a rent bump to 71,925. Oops, that's 81.
So that's starting year 6, though, right?
I think it's because the building in year 1, 2020, already counted its lease as 1, 2, 3, 4, 5. So 2020 to 2025 is your base lease here, and then they have a rent bump in year 6 of the lease, which would be year 5 of your operations as we're purchasing in 2021.
Perfect.
So yeah, they indicate a rent bump here in year 5 to 71,925. So a small, I believe that's within the 4% ish range. And we're going to go here to operating expenses. Remember, I said before, guys, it's not hard to underwrite one of these deals, especially when it's something like this, a ground lease. Your expenses per square foot is a big fat 0. You don't have to spend anything. So your net operating income ends up being exactly equal to your gross potential rent, right? Because you are getting the exact same amount of income as your gross potential rent here. So because you're not spending anything on ongoing expenses, and so all these non-operating expenses here, right? Mortgage interest and principal reduction is not applicable right now. So that's something to look at. If you are buying this through an investment group, there might be an asset management fee. Would you like to have this in here for right now?
No, let's leave
Tyler?
that. Let's leave that blank, assuming somebody just pays cash for it.
So we're going to look here at our profitability, right? We're making 71,000 in year 5 here, 68,500 in year 1, right? Our return on investment, cash on cash return, which is our entire return because we are investing in cash, is 5.59%. Now, the cap rate of this that we're purchasing at is 5.75%. The reason why this cap rate is the return on investment is actually slightly lower than your cap rate is because we're spending those additional closing costs up front, which brings up your cost basis, which makes the full property that you're purchasing actually cost a little bit more, right? So that's why your return on investment here is not exactly equal to the cap rate on this property being 5.75. So that's something to think about there as well. But reallocation here, this means if you are investing in a general partnership, if there's a syndication going on, reallocation is essentially the amount of money, proceeds that goes to the general partnership, the syndicators, as a reward for them putting the syndication, putting the project, running the project together, right? In this case, we're looking at it as a 100% cash deal, or even when we go back here and we look at financing here in a second, still probably as a one-person deal. This is a $1 million property, so we're not going to have any sort of reallocation here. So your investor cash flow is this. Your investor return on investment, cash on cash, is 5.59. And as you see here before, our cap rate is actually 5.75%, slightly higher, moved around tiny bit because of those closing costs. So when we look here at our exit rate, so our value at exit rate, this is one of the most important things that you can do, is determining the cap rate at exit. Okay, because essentially the cap rate is the number one driver of the value of the building. And when you sell, you want your cap rates to be low because that means your value is high. And when you buy, you want your cap rates to be higher generally because that means the value property price is lower. So it's kind of backwards there. You might think, oh,
Yeah, inversely
correlated.
correlated.
Exactly. You might think, oh, high cap rate sounds good, right? I want to a property that, and remember, I guess I'll step back for just a second. What is a cap rate, right? The cap rate indicates roughly your expected return on investment if you're investing all in cash, right? So it is the net operating income divided by the total purchase price of the property. So you might think, oh, high cap rate, good, right? Because I'm getting more cash, right? More higher return on investment if I'm investing all in cash than if I have a lower cap rate. But when it comes to your valuation of the property, because that's inversely correlated, you're actually going to have a lower price at sale if you have a very high cap rate. So typically, you're going to want to keep your cap rate really close to what your initial cap rate was, right? Because unless you foresee something weird happening 5 years from now and you have a crystal ball and you can see into the future and you know exactly what's going to happen in 2026, it is safe to assume that cap rates are going to be pretty similar to where they are now. And we talked about how historically from 2017 to 2018, we saw that the cap rate went down 0.1%, right? 10 basis points. But it's not prudent to underwrite a cap rate going down in order to make a deal work. And the reason why is that historically, cap rates go up for individual buildings over time because the buildings get older, right? They deteriorate, they need more upkeep, they need more maintenance. There are new buildings that have been built that have higher quality finishes, more amenities, maybe better locations. So your older building is not going to be as valuable, so your cap rate is going to go up. That's how it's supposed to work. Within the last 5, 10 years or so, ever since the great financial crash, cap rates on everything have been going down because of access to credit and the amount of demand for investing into real estate becoming a more standardized, institutionalized market than even it was 20, 30 years ago. So cap rates have been going down, and that might continue to happen as people continue to chase yields. But it is not advised for you to underwrite cap rates going down.
Yeah, another point to take into consideration there too is the length of the lease, the remaining lease term. You know, when you first buy a brand new building, you're looking typically at a 10, 15, or 20-year lease. And if a tenant does elect to exercise one of the renewal options, those are typically 5-year renewal options. So there's obviously more risk on that lease, just because they could leave after 5 years and you don't get 10 years or 15 years out of it.
Exactly, Tyler. So what I recommend, and so you could, if you want to be aggressive, you could keep the cap rate at the same price as you bought it, right? 5 years from now, you could keep the cap rate at the same price you bought it. I think that's a little bit aggressive. That's not how I would like to underwrite my properties. And especially because, I want to make sure this, when Tyler and I are looking at investments, we're not just investing our own company money, we're also investing our investors' money. So we have a responsibility to protect their investment and be safe and try to plan for the future as best we can. I like to underwrite the cap rates going up. And a pretty typical way to do that is to raise it a few bips per year or basis points per year, right? And so if we say we raise this 5 basis points per year, 5 times 5 is 25. So let's do 5.75 plus 0.25, right? And let's underwrite it. I guess it doesn't work because I need an equal sign here. Whoa. let's make this percentage. There you go. 5.75 plus 0.25 is a 6% cap rate. So that's how I'm going to be valuing it at the close here, right? Which again, that might be aggressive. We've been seeing historically that cap rates actually tend to compress. And, given the amount of liquidity we have in the market, that might happen. But again, I don't think you should underwrite that way, and you should be safer. You should assume that your cap rate is going to go up over the term. And if your deal doesn't work with the cap rate going up over the term, it's probably not a deal that you want to be investing in, at least not at the asking price, right? So that's always important to consider. So we're selling for 1.198, right? Which is very similar to what we bought it for. Unfortunately, because that property price went up, you would hope that there would be more appreciation, and there very well could be, right? Again, it might be on a growing corridor in a city like Nashville, in a submarket of Nashville here, where, even with all the things that we mentioned before, with tenant risk increasing, with the length of the lease getting closer to the expiration, with the building getting older, et cetera, et cetera, et cetera, with other newer buildings being built, if you're buying in a better location, like in Nashville, it might just, the cap rates, despite all those other things, might go down because people just want the property more. So that's something to consider as well. So our exit proceeds here, we're assuming, let's say so 93% here is assuming what? A 6% brokerage fee and a 1% other closing cost sale here, or more, maybe closer to a 5% brokerage fee and a 2% closing costs at sale. That's kind of high. You're not always going to be paying 5% brokerage fees to sell a commercial building, but this is a much smaller commercial transaction than typical. So usually on the much bigger commercial properties, the brokerage fee is going to be lower, right? And Tyler, in your experience, has that always been the case that usually the higher price properties has a lower brokerage fee, and the lower ones like this that it's at $1 million, it's going to be higher?
That's exactly right. I mean, look, there's no set brokerage fees, right? There's no market rate or anything like that. Everything is negotiable. Typically, what we see is in that 4 to 6% range until you start really getting into the higher numbers. I mean, we did an $18 million deal that had 2% that was split between the brokers. So it can be all over the place. It just depends on how it's negotiated.
Exactly. So having here 93% of your exit proceeds seems reasonable to me. So you see here what it would be at your sale, the sale value here, and the amount of money you'd be getting to your pocket. Here's your capital accounts, right? Capital accounts being the amount of money you put into the property up front is at 1.225 million, right? And so your total profit from the sale here is actually negative at the year 5 because of what we said before, because of the cap rate going up, underwriting it with the cap rate going up. When you're buying something all in cash, you actually might be losing a little bit of money from the sale here. But that doesn't actually mean you've lost money over the term, where your total return on your investment is 20%. So from the million you put down, you have made 200 grand over the course of the 5 years, which is an annualized return of 3.84 or an IRR of about 4%. So that's not fantastic, but considering that we probably are pretty aggressive here on the cap rate, right? Or pretty conservative here on the cap rate, that's not bad to say I have a 4% kind of baseline scenario that I'm looking at here. I have a 4% baseline scenario of making 4% average return on my money over the term, right? And that's what the IRR indicates.
One
And
thing to
also,
note too is that a lot of these triple net investments are done with 1031 exchange money, which means if you can, sometimes you get into an investment that's just not quite ideal. It's not the best possible return, but you can still move cash or your equity out of one property into another without having to pay capital gains taxes, which is 20%. Right, so you're saving 20% and you're still getting a return on your capital without having to do anything for it. There's different ways to look at it than just a 4% IRR as well.
exactly. And also, I wanted to mention that your loss of money here, loss quote unquote, in 5 years from now at 110 is due to inflation, actually not 110, right? So money now is worth more than money later. So that is something to consider as well in terms of time value of money, all that kind of stuff. And we can kind of see this as your baseline scenario. If you're in that 1031 exchange situation, you want to park some money here, you're saving 20% on capital gains tax, and you're making 4% on that money every year. Not bad, right? But let's say maybe that we're a little too conservative here and you actually get a 5.75% cap rate. You can add another 0.7 percentage points here into your IRR. So, and this is called doing a little bit of sensitivity analysis. What happens in, a good, better, best scenario, right? If, let's say, cap rates do continue to decline, and I think this is very speculative, but let's just see what happens, right? If the cap rates continue to actually to get lower, right, than when we purchased it, then potentially you're looking at, oh wow, like adding a lot here to 5.5 percentage points IRR on a 5-year return where you did literally nothing but collect the checks. So those are things to consider as well here, that you might be doing well, and selling this property at the end of 5 years, you might be able to roll it into another 1031 exchange and not have to make any capital gains on this either. So that is kind of what we're looking at here. So I'm going to go ahead and change this back to, I guess, before I do that, Tyler, we can have some final thoughts about this deal as an all cash deal, if you have any.
Yeah, I mean, I would say so. First off, with the sensitivity test, we do that throughout the spreadsheet in various different areas. We'll go through and we'll underwrite it in the ideal case, what we think is actually going to happen, and then we'll go back and do a more conservative case, and then we'll do a more aggressive case, kind of like what Andy just did, so that we can see, okay, well, here's a good, better, best scenario of what could potentially happen with this project. But look, as an all cash deal, I mean, this doesn't necessarily excite me. That doesn't mean that it's not a good deal. I'm an active real estate investor. We buy, high vacancy, riskier projects because we can get in there and add value and create 15 to 20% IRRs, right? And on a shorter time horizon usually. I mean, this is a 10-year deal. Those are typically 5 to 7. I think that if you're able to save 20% on capital gains tax and keep your money at play and you don't have to do anything for it, there's nothing wrong with cashing a $68,000 check a year. And sometimes you don't have another option. 1031 exchanges are very quick. You don't always have enough time to get in there and find something that has a better return. But I think this is worth considering. But the next case scenario where we're going to show you, I want to see what it looks like with 25% down and 50% down, because a lot of investors will bring half the money to the table, right? They won't have the full purchase price, and that will drastically impact your returns. So paying cash, maybe you could pull a line of credit against it and use that to go acquire other sites, in which case that could make sense. And then you're getting into a much more complicated version of underwriting, because it's tough to really say what your returns on that project are because you're technically pulling cash out. But yeah, that's my thoughts on it as an all cash deal.
Yeah, I totally agree, Tyler. I think that's pretty accurate here. If you are just looking to get a 1031 exchange here and trying to be in, I think that's a pretty reasonable thing to do. So let's do exactly as Tyler indicated. Let's add some financing here. So instead of 100% down payment, what happens if we bring 75% of the money? And now that we're talking about financing, I do want to touch here on interest rate and amortization term here. Currently, the interest rates for a stabilized, more guaranteed property like this, you can probably get a better interest rate than 4%. But again, as Tyler and I have been saying, right now, as of April 13th, 2021, interest rates are on the rise. But I still think you can probably get a better interest rate on a stabilized property like this than 4%. But we want to be conservative, so we'll start here at a 4%. And amortization term of 20 years is pretty typical. Usually there are 20 to 25 year amortizations, and they're going to be usually 10-year loans, 5 to 10-year loans with that 20-year amortization. So 20 also might be conservative, right? We could potentially put it at a 25-year amortization. And the difference there is that on a longer amortization schedule, you have a lower monthly payment. You would be paying more interest over the full 25 years if you held it for 25 years. But, not everyone, and actually, we're really not able to predict at all what the world looks like 25 years from now. I mean, if you can give us a call, we'd love to chat with you and get your investment insights. But
that's right.
But generally, people want to prioritize having more cash flow now. As we said, time value of money, the better your cash flow is now. So having a lower monthly payment because it's spread out over a longer amortization term is typically what people look for. But again, conservative here, 4% interest rate, 20%, 20-year amortization term is, I think, well within attainability for most people, especially if you're bringing 75% down. Like you're going to be able to get a great loan, because loans are given out based on risk, right? And the riskier the loan is, the worse terms they're going to give you. Well,
yeah, and one thing I was going to say too, I mean, if you're bringing 30 to 35% down or more, that's when you can really start leveraging that risk with the bank, right? Because you got to look at it from their perspective. If they have to foreclose on this property, whatever amount that you brought as the down payment is their spread in the deal, right? Because they can foreclose on you. You brought 35% down. Well, they can take a 20% spread and leave 15% for the next guy, and they can get rid of it quickly, make their money back and a return, and move on because they're not in the business of real estate. They don't want to be in the business of real estate. They want to be in the business of money. So that's how you can start really arguing or negotiating for a 25-year amortization or a couple points lower on your interest rate, which makes a huge difference in some of these deals.
Absolutely, Tyler. So that's something to consider here as well. But we'll just see what a 75% down payment is here, and then we can go back and kind of tweak these numbers. It's not going to make drastic changes to a model like this, but these are the types of things that you want to be going through and thinking about when you're trying to underwrite. So
Exactly
we don't really
right.
have to change. We don't have to change anything else here, right? All these things stay the same. We're going to keep this extra rate value here. So what are we looking at? Actually, believe it or not, I think our IRR is actually kind of lower than, or was it 3.84%? I don't actually remember what it was just now. 3.9%. But anyway, the 3.9% IRR here is what you're looking at with this financing. But I guess again, we said, what are we looking at if potentially you get a better term? Maybe a 25-year amortization term, you have a lower monthly payment, and maybe they're saying, okay, you're literally bringing 75% of the cash to this property down payment. That means the property price would have to fall 75% for me to lose money as the bank. And there's just no way that's happening. If property prices fall 75%, it didn't even happen in the Great Recession. If property prices fall 75%, I mean, you've got bigger problems.
Yeah.
Like, this is U.S. government collapse territory. So it doesn't really matter what your portfolio is doing at that point. So in understanding that, if I'm the bank, I'm like, okay, yeah, I can give you a better term because you are bringing so much down, right? So if we say we bump the amortization term here and lower the interest rate, what are we looking at here now? It went from 3.9 to 4.07, which is not huge, right? It's not a major increase, but these percentage points or 0.2 of percentage point does make a difference in terms of compound interest over time, and are things that you're going to be trying to go after, right? So that's something to see there. So let's see what happens here if we make this a 50% down payment at 4% interest and 20-year amortization term. We're going to see actually a 3.76% IRR. So we were looking here at a 75% interest rate, right? And so if we want to look at a 75% down payment, if we want to look at a 50% down payment instead, right, where you're bringing half the money to the table, and we scroll all the way down to the bottom, we actually see that our IRR goes down. Our IRR goes down, and that's not typical. That's not typical for an investment. Usually you want as much leverage as possible. You want as much leverage as possible because usually that's going to juice your amount of money that you have to come out of pocket for and the amount of upfront capital you're going to spend. And so if you have to spend less upfront capital, especially on a sale, when you have net profits on a sale, you're going to get all that benefits of the property appreciation from that sale, but you brought less money to the table to start with, right? So typically people want actually higher leverage. In a property like this, though, where you have actually a lot less benefit from a sale, where you're actually seeing we're really not making any money from the sale here, negative $10,000, negative $11,000 from the sale. This is not actually something that having higher leverage is actually going to lower your IRR, because you ended up having to pay mortgage interest that is essentially just lost money to the property. So that's something to consider when looking at these triple net investments. If you are, like I am right now, underwriting a loss in year 5, even marginally so, then that's something to something to think about, that you might actually want to lower the amount of leverage as possible. And obviously, if you're able to sell the property for cheaper, right? This is assuming 5% selling cost of brokerage fees and 2% closing costs. If it's something like, you know, 94%, where you're actually slightly profitable at the end, your IRR is going to be higher. And if we went back and we looked at the numbers, having higher leverage probably is going to end up boosting our internal rate of return. But as it stands here, we, you know, again, we're trying to be conservative. We're trying to present to you guys the reality, not a dream where, oh, if I had no selling costs, then I would make a lot more money. It's like, yeah, it's like, you tell me when that
Obviously.
happens, right? So we're trying to present to you kind of the reality, and so this is something to take into consideration. A deal like this is not going to necessarily be better financed. It's not necessarily going to be better financed.
One thing that I will add to that, though, is that it's going to largely depend on the debt terms, right? So right now we're at 4% and a 20-year amortization. I could easily make an argument for a 25-year amortization and a mid threes interest rate. So Andy, let's show them what that would look like.
Right. A mid threes amortization, 25-year amortization term. Whoops, let's make that 3.5. Right, and that's going to boost your IRR half a percentage point there, from 3.7 to 4.27. Right, pretty good, pretty good. Just on a couple keystrokes for the lender is going to be half a percentage point on your investments. That's great for you. So that's something to take into consideration as well, exactly as Tyler said. But overall, I would say that this picture of the property with investing it only in cash is probably going to be your better option if you were looking at this specific property, underwriting it the same way we did. Now, if you wanted to make a case for continuing to have the same exit rate, I think the cap rate here is, again, the biggest thing that we have to consider. If you can make a case for that cap rate staying the same or going down, then obviously it's a much better deal. But you could say that about anything. You could say that about any deal, right? So if we're applying, being generous to this deal, then you want to be generous to other deals as well, because when you're considering investing, there's obviously opportunity cost, and you can only put your money in $1 bill, can only go into one project at any given time, right? So it is tempting to say, well, I think this can be better. It's like, yeah, but if this could be better, another project could also probably be better at the same time. So when you're considering that as well, I want to caution people away from saying, hey, let's stretch the numbers here, make it juiced. It's because you can stretch the numbers on anything and make it juiced. So that's kind of the overall takeaways from this property, Tyler. I think that it might be a decent option to look at if you're in cash, right? You're having a mid fours kind of cap rate here, and even at a 25% down, bringing a little bit of money to the table, that you're still at that kind of low to mid fours interest rate, IRR, rather, return on your investment annually. So, not out of this world, incredible, amazing. Anybody should buy this today, but it does make sense for the right person in the right situation. 1031 people with a lot of cash who want literally zero responsibilities. And I think that can't be stressed enough. Even owning stocks, even owning, stuff like that, you have to make the decision at the end of the day whether to buy or sell. If you're in a portfolio managed by somebody else, you're paying fees on that portfolio as well. So this is something that literally requires close to zero brain power. You don't have to manage anything. You don't have to upkeep with the building. The building, they pay for all the utilities, maintenance, repairs, CapEx stuff. You just collect your money. So that is why we're not seeing an incredibly crazy rate of return, is because you are not putting a lot of work into the property.
One thing the spreadsheet also doesn't take into account that we are working on is the tax depreciation and the tax benefits. that you get from owning this property. So that isn't even included in all of this, but it's a brand new building, right? So you could come in and do a cost segregation study and perform accelerated depreciation on the property, which would shelter a significant amount of not only this income, but potentially income you're making on other properties, right? Depending on how your ownership structure is set up. So that could actually, that 4% return could actually end up being significantly more than that, just based off of what you could write off for the property. So, again, it all comes down to a global scope of how your portfolio is set up. It's not always black and white. You can't just look at a property and go, oh, well, the total return over 5 years is almost 21%. That's not worth doing. Well, I mean, if it gets you a significant amount of tax write-offs and depreciation and benefits in that respect, then for a lot of people, it's worth it. If you save 20% on capital gains tax by keeping your money in play, that for some people is worth it. So there's a lot more to take into account, and we'll add that in, that cost segregation or the tax depreciation benefits as soon as we figure out the best way to integrate it into the spreadsheet, because I think that would help everybody kind of understand the global scope of the project. Because look, if you're comparing this just based on those returns to a stocks and bonds, you'd probably just pick to go the stock market route, right? But you don't get a lot of the benefits in the stock market that you do out of owning a piece of commercial real estate.
Absolutely, Tyler. You hit the nail on the head here. We're working on bringing that depreciation model to you guys as much as possible. And again, we will say when we do put it out that we're not tax professionals. You should definitely get consulted with your tax professional when you're looking at, hey, how do these tax benefits affect my returns? But that is something that owning real estate is one of the most highly tax advantaged investments, if not the most tax advantaged investment in the United States. So we are definitely trying to help you guys figure that out as well. And there's going to be much more to come on that.
That's exactly right. So if you guys enjoyed this underwriting session, we're going to be doing these every Wednesday live at 5:30 p.m. We didn't do it live this week because Andy and I are actually in Chattanooga, probably as you're watching this, working on New Old Tower. We've got a bunch of meetings out there this upcoming Wednesday. Also, if you have any questions on underwriting in general, leave them in the comments below. Andy and I will get back to you. We'll get those answered. We'll be underwriting mostly triple net properties starting off, but then we'll get into some other, value add investment opportunities, just so we get you guys kind of a variety of projects to look at. And until then, we'll see you guys next week.